Good morning. Welcome to Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I am Reema Tendulkar. With me is Hormuz Fatakia. Markets have opened in the red, down nearly 90 points at 11 o'clock. The Nifty below 25,500, snapping yesterday's winning streak. Benchmark indices are lower by close to about 0.3%. Lots of factors perhaps contributing to the decline. One, Asia is a mixed picture. So markets across Japan, China, Hong Kong are all slightly muted in trade. So they've got a red tick going for themselves. Yesterday, remember, the FIs were large sellers. More than 4,000 crores sold by the FIs in the cash market. And plus, there are IPOs open, large one. Today is day 3 for Pine Labs, Grow, that's a mega one, which opens today. MV Photovoltaic is also open. So that perhaps is also on the sideline, sucking liquidity out of the markets. And not to forget, today is the Nifty weekly expiry and then some disappointing earnings, particularly the Bajaj Finance, which has dragged down Bajaj Finserv too. We'll get talking about all that. That's the picture across the markets right now. Let's put the spotlight on the top movers in the market. Hormuz joins in with more. Hormuz.
And the earnings reactions, as you mentioned, and there are quite a few. And of course, as has been the trend over the last few quarters, they've always been on the extreme on either side. Start off with HEG, the top gainer on the Nifty 500 today, snapped a 5-day losing streak. And before this 5-day losing streak, the stock had gained for 8 days in a row previously. And the stock has had more than 90 lakh shares that have traded in today's session. The 20-day average is only 4.5 lakh shares. So gaining on strong volumes. The stock took support at its 50 and 100 DMA levels, which is at around 520, and has rebounded from those levels. And as a result of today's move, the stock continues to remain positive on a year-to-date basis. HBL Engineering was among the top gainers yesterday, is among the top losers today, has given up more than 50% of Monday's fall, now down almost 8%. And volumes today are still 1/6 of Monday's volumes. Monday's session had more than 3 crore shares that were traded. Today we have had almost 50 lakh shares already traded in the first 2 hours. The 20-day average is 12 lakh shares. The stock, despite today's fall, remains above key moving averages because it has had a very good year despite today's fall. It's still up 65% year to date, and as a result of which it continues to remain above very important levels. Another earnings reaction is HLE Glasscoat, and the stock is down 17% now. It's down in 4 out of the last 5 trading sessions. We had close to 20 lakh shares that have been traded. The 20-day average is less than 2 lakh shares on the stock. So 10x its 20-day average is when the stock is seeing these kind of declines. The stock broken below its 50 DMA and now at a very crucial 100 DMA level, which is at 486, and again has had a fairly decent year so far, up 33%. So and lastly, Urban Company, the stock was down for 5 days in a row as of yesterday's closing. It has snapped that 5-day losing streak today, up 7.5% on very strong volumes, almost 1 crore shares that have been traded on the stock, 20-day average of 30 lakh shares. And as of yesterday's closing, the stock was down almost 33% from its post-listing high, which was over 200 rupees, Reema.
Thank you very much for that. Let's begin the show. We've got lots of corporate conversations going on. First up, WeWork India reported their Q2 numbers. The company's top line went up by 17%. EBITDA margins came in at 20.3%, slightly lower compared to the prior quarter. Karan Virwani, MD and CEO WeWork India, is joining in. And Karan, congratulations. I think the company has achieved Ind AS PAT of 6.4 crore, which is the first true profitability if you strip out the tax credit from last year. So congratulations on that. But let me start with the top line and the margins. Revenue growth for you was about 17.5%. And yesterday we were chatting with a peer of yours, IndiCube, and their revenue was in excess of 30%, and they're confident about 30% sustaining for the rest of the year. So, juxtapose your performance with the industry in Q2 and what you expect on the top line and margins in H2.
Sure. Well, and thank you so much and good morning. I think to start off with, on the capacity side, if you see year over year or just from last year, we've grown over 21%, which is higher than the industry, the rate that the industry has grown. So capacity has grown. At the same time, we've seen occupancy move up drastically in the last 2 quarters, nearly 5% of, occupancy add from 76 odd percent to now closer to 81% for this quarter. Revenue has gone up, like you mentioned, to 585 crores, which is our highest ever revenue, 7% quarter over quarter, 17% year over year. And just to correct, IGAP EBITDA, which is about 118 crores, has grown almost 45% Q over Q to now about a 20% margin, right? Which we're seeing with the business sort of ramping up and occupancy sort of moving up as well. And rightly, like you mentioned, 6.4 crores of actual proper operating cash, which was negative 34 crores just a year ago. We've seen that transformation and now hit this big milestone for the entire industry as well. If I have to just draw a comparable, I don't want to mention about other operators, but if you just look at the revenue base that we have, it's nearly 30 to 40% higher than anyone else in the industry or some of the industry benchmarks. So there is a scale factor playing in here. I think at lower revenues, we were growing upwards of 40% as well. Today, we're growing at, roughly about 17, 18%, versus our net license fee has grown over 22% in the last 1 year itself. So we believe that the business at scale still continues to grow and will grow above 20%, and you will see that ramp up happen over the course of the year as well.
So 20% plus revenue growth, Karan, in the second half of the year?
Yeah, I think overall, just year over year, that's the type of growth that we're targeting. Yeah, we think that we are on track to get there for sure.
Karan, thank you for joining in. What about margins, as Reema was asking? And you've also earlier highlighted about wanting to be an infrastructure partner for GCCs. We heard you speak about it during the Global Leadership Summit as well. What is your strategy with regards to that? And of course, first your word on the margins.
So margins, are growing healthy. If you just see the EBITDA margin, which we measure on an IGAP basis, last quarter was about 15%. As of Q2, it's grown to about 20%. So that's been a 5% increase in margin. EBITDA was about 81 or 85 crores last quarter. It's grown to 118 crores this quarter, which is a 45% increase in the operating margin. IGAP equivalent PAT, which we also look at over the last few years, was at about 40 crores, which is about a 6.7 PAT margin for the quarter itself, and nearly 47 crores for the entire first half of the year. So business is operating well. Margins are hitting. Operating leverage is kind of kicking in, driven by demand and occupancy ramping up. And mature centers now are upwards of 84, 85%, which was nearly about 79% just 1 quarter ago. So we've seen a big ramp up in the occupancies of those centers as well. Our operating or our growth centers are also now operationally breaking even at a much lower occupancy than the portfolio. So that shows that the operating discipline in the new cohorts is also starting to play out, which will soon reflect in both the revenue and the margin coming in. Just an interesting point, almost 80% of our incremental revenue from here will basically flow down to EBITDA and then finally down to PAT as well. Just touching on, your point on GCC as a service. Yes, we are looking at productizing the entire GCC as a service platform. We're very focused on delivering just the infrastructure part of this. So that starts with workplace delivery, being able to have multiple models like an entry model, a scaling model, and then a maturity model for GCCs. Over and above that, we're doing services like transport, F&B, employee engagement, and even offering design build services for certain companies that just want their own space. The idea is to finally move WeWork from co-working to doing enterprise grade offices, which we're already doing and is about 20% of the business, to finally a proper infrastructure or a workspace as a service business where we're able to offer flexible spaces, long-term permanent spaces, but also cater to all type of design, build, operating requirements that companies might have in the future.
Karan, many more questions, but unfortunately out of time. Thank you very much for joining in. That's WeWork for you. Slip into a break. On the other side, we'll focus on crypto markets with Adib Nurani from Market Wizard. Stay tuned.
Crypto Corner, powered by CoinDCX.
Welcome back, and on Crypto Space today we have with us Mr. Adib Noorani, founder Market Wizards. Mr. Noorani, hi, thank you so much for joining in. If you look at crypto as a segment or an asset class for the year 2025, it can perhaps be divided into two halves. The first half was all about the US president taking over and very friendly regulations coming in. Almost everybody was out to buy cryptos. The second half has been about profit taking with volatility. How would you read that through?
Thank you for calling me, madam, here. Good morning. Good morning, all the viewers. Well, the first 6 months were undoubtedly very good. The second 6 months were also expected to go up with a small profit booking, but the all news flow which came in after Trump coming in as the president, there were very, very bad news flows for the market, and then hence it was a surprise for all the investors and all the institutions. So once to get themselves safe, they have started booking the profits, but further down, I see that still there is a pressure left in the crypto space, and BTC will go to newer highs before it goes down and corrects much more below the 1 lakh level.
Mr. Noorani, also, when you look at crypto as an asset class yet again, what is the quantity of your portfolio that you should be or can be holding in cryptos?
Well, I always say that if you have a suppose I have a portfolio of 100 rupees, then 10 rupees should be allocated into crypto. If you are a conservative investor, if you are a little bit risky investor, you can go up to 20-25%. Out of the 10 rupees which you invest, or out of the 20 rupees which you invest, around 70 to 80% should be into BTC, and remaining 10-15% in altcoins, and remaining 5 to 7% in memes and all small coins, so that small coins will not eat away all your profits if it goes down or rug pull is happening. And at the same time, your bigger part, which is BTC, will keep all your portfolio safe.
The way the prices have been volatile, and as you mentioned as well, that the Bitcoin will perhaps hit a newer high before it goes in for a profit taking, and levels of below a lakh as well. What charts would you look at? What would you advise to people who are investing, wanting to invest afresh as well?
Well, if you look at the charts as an investor, you first need to look at the cycle of the BTC, which occurs every 4 years, wherein halving is factored in, wherein all the news are factored in, wherein everything, all the supply and all that is factored in. So as an investor of long term, you need to see quarterly charts wherein you will find how the cycle is working. But the problem with the investors today is they go and see weekly or monthly charts. In BTC, that doesn't work that way. So if you are a trader, you can go into the intraday charts. If you are a swing trader, you can go to a hourly or daily chart. But then what people do is they go to daily chart and see how do I invest in BTC. To be invested in BTC and to invest in BTC, you need to understand the complete cycle of BTC. And if you understand the cycle of BTC, no volatility will make you impatient. You will be patient and you will hold BTC forever, I would say.
All right. So are you saying that it is the long-term investors who actually end up making money rather than the short-term guys who are trying to just about play the trend?
Yes. If you are a short-term guy, you need to do intraday or maybe swing trading of 4, 5, 7 days. But if you say I have to hold it for 4 or 6 months or 1 year, BTC will not give you a lot of money because it has got a cycle of 4 years. So after 1 and 1.5 years of good profit booking, good rally, it will give a profit booking. Usually the cycle goes in that way. 1.5 years is good rally, 2.5 years is consolidation and downtrend. So what happens with people holding it for 6 months or 1 year, they get into that trap of 2.5 years, which is of downtrend. So that's the problem. So for BTC, I would suggest for everyone, either go for intraday or few day swings, or go for long-term investment. Don't hold it for few months. It will not give you good returns if you don't time in properly. And usually people will not able to time in properly because there is a lot of news flows and there are a lot of institutions playing around.
You mentioned that 70 to 80% of a portfolio should be Bitcoin, perhaps 15 to 20% of altcoins. Within the altcoins, what would you want to watch out for? And when you say 5 to 7% perhaps can go in for meme coins as well, what coins are we watching here?
Look, when I say altcoins will be all technology coins like Ether, BNB, Solana, and all those top altcoins. And if you go for meme coins is a subject like you can't mention a coin. If I mention something here, tomorrow that coin may change. So you need to keep going with the trend, and you need to put very small money in those meme coins which are running, because every now and then meme coins coming up and going down. So you can't suggest meme coin in the public forum. But then, yes, for altcoins, go for top 10 altcoins, and top 5 would be BNB, Solana, Ether, maybe Ripple, and all that kind of coins, and BTC being the king. We have already defined it. So meme I
Absolutely.
wouldn't suggest on the public forum because it keeps changing, ma'am. If I say something and after a week it is being rug pulled, then you and me will be blamed that you said that meme and bought it.
Well, absolutely. That is the kind of risk meme coins hold. But when they give you a return, they give it to you in plenty. But as you said, it should be perhaps a minimal of your holding, and that too also for a short term there. Adib Noorani, as always, thank you so much for joining in and making sense of this subject called Bitcoins and cryptos, of course. With that, we'll go for a very short break. When we come back, we'll talk more about markets and stock specifics.
CNBC-TV18 presents Crypto Corner, powered by CoinDCX.
Welcome back. Continuing our focus on corporate conversations, we are now being joined by the management of CE Infosystems. It was a muted second quarter. The revenues were up, but the operating performance was weak. Rakesh Verma, the co-founder and CMD of Mapma India, now joins in. Mr. Verma, good morning. Thank you for joining in. Now, with the kind of growth that you have had in the first half of the year in terms of top line, what are you guiding for the full year? And what is going to lead that growth? Will it be the high margin business that will contribute more towards the growth in the second half?
To answer your, first, let me thank you for inviting me to your channel. To answer your question very direct, the answer is yes. The second half we have been discussing, and we are very bullish about the Q4. And so the projections that we have given for the year, both in terms of the revenue growth and for the EBITDA or profitability, is going to be as planned, and that's how it looks like at this point of time.
Mr. Verma, morning. This is Reema here. Can you help us with the projections on revenues and margins for the full year and second half?
Well, as far as the margin is concerned, we have always maintained that it will be anywhere from 35 to 40%.
Okay.
And if you see the half year H1 also, it is more than 35. So it definitely will be closer to 40 than closer to 35. As far as the revenue growth is concerned, we are expecting for the whole year a revenue growth of anywhere between 20 to 25%. As of H1, it has been 14.7%.
Okay. But sir, your margins in Q2 were particularly depressed, I think closer to 24-25%. And there was this one-off technical services outsourcing expense for a specific government project. Does that reverse? Can it repeat? I mean, how do you get to EBITDA margins of closer to 40%? And what is the share of government revenue now?
As we explained it in the earnings call just half an hour back or so, see, we are investing heavily into 3-4 areas. For the long term, when I say long term, I don't mean 10 years, I mean 1, 2, 3 years, investing heavily in 4 areas. One of them is the areas where related to the government business, which means related to road safety, related to defense, and related to railways. Now, when we are investing there, because we see very large opportunities that's coming, and particularly using our platform and product, not a classic services business. The other area we have already invested is from our international joint venture. And the third area we are investing is to make our product to the next level, the consumer-facing Mappls app. Now, particularly in Q2 and Q3, we get the opportunity to focus on this new businesses that we need to create, whether in terms of technology product or the opening up new business opportunities. And the operating revenue of Q1 and Q4 look like more from making sure that the revenues and the projects are delivered.
So, Mr. Verma, just to give you a number, how much of your total business now comes from the government? That's one. And two, there was a certain increase in expenditures like technical service outsourcing during the quarter. Are these expenses one-off? And do you believe that, or do you believe that these will increase going forward?
Okay. First is this was one-off. We have mentioned it in our presentation. Whether it will increase, not related to this particular initiative related to the road safety. It will come down. But we have other opportunities in railways and defense where something else may happen. But while we do this, we ensure that our overall EBITDA margin remains intact between 35 to 40%. Your question about
Government share.
How much is the government's revenue share? Now, government's revenue share, if I say as of today, H1, it will be somewhere in the order of 20%.
Okay. Mr. Verma, short conversation, but we're out of time. Lots of earnings to track today. Thank you very much for joining in. That's Map My India for you, talking about a 20 to 25% revenue growth for this year, FY26, with EBITDA margins at 35 to 40%. Stock, though, is down 5%, 20% lower from its 52-week high. But let's get to the big story, and that is Britannia. It is among the top losers following the resignation of Varun Berry. Manglam joins in with a chat on this. Manglam.
Well, if you look at, Britannia, what you know is that Varun Berry has been a phenomenal leader for the company. Ever since he joined and under his 13-year tenure, the company's revenue has actually increased by 2.5 times. The EBITDA has increased, or margins have doubled from 9% to almost 18%, and the net profit has jumped by almost 6 times. And all of that has equated to its market cap jumping 18 times. So when a leader of that sort leaves a company, the street does feel that, okay, there are some jitters, etc. But that was pretty much expected because he was there for 13 years. What the street is more, worried about right now is the abrupt end to this glorious leadership. Because if you notice, the company had actually appointed Rakshit Hargave as CEO with effect from December 15th. And the street actually liked that, despite, softer than expected revenues, the volumes declining by about 3%. The street liked this transition, and they believed that, okay, there is a new leadership at the helm, which will take the company into a different direction, and the transition would have been smooth. One would have imagined that Varun Berry would stay on as MD for a bit, and thereafter, both Rakshit would take both the positions, MD and CEO. And understandably, Varun then put his, resignation, saying that he's willing to go ahead and serve the notice period. What the street is, not liking is the fact that the board has immediately accepted the resignation and waived off the notice period as well. And what that has done is it's caused a bit of a vacuum for the next 1 month, ever since, since Rakshit takes over as CEO, and he's also been appointed as the MD. And in that interim, they have N. Venkatraman, who's the CFO of the company, who joins in. So that there has to be a leadership transition is pretty much norm for businesses, but that it has been so abrupt has the street a little worried about, whether the leadership stability will continue or not.
So what are possibly the next triggers that are lined up for Britannia now that you have that vacuum at the top?
Well, a couple of things, whether there is vacuum at the top or not, the business is fairly strong. It is still the highest market share in the, premium biscuits category in the country, one of the largest in terms of reach, etc. as well. And the second quarter was a transitory quarter. Over 80% of their portfolio now comes in a 5% GST. So it's improved volume growth post-GST. Varun Berry himself has said that, from mid-single-digit volume growth, they're likely to go into high single-digit volume growth because of the GST cuts. So that will play out in the third and the fourth quarter, the second half of this year. Continued margin improvement. Varun had actually put the company on a strong cost path as well. And now there is some predictability, stability in raw material prices, and then growth in adjacent categories. Right now, adjacent categories account for a very small portion of Britannia's overall pie, so to say, but has been growing extremely fast. So, croissants, dairy, and all these other snacking items that Britannia is coming out with could be on the path of making the company a total foods company. And finally, we'll watch out for new product launches and increased distribution, increased penetration in the hinterland of the country as well.
Interesting. Thank you very much, Mangalam, for explaining that so beautifully. Get into a break. On the other side, we've got another management waiting by to chat with us, Aether Energy, to talk about Q2 numbers and the outlook going ahead. Welcome back. It's the Nifty weekly expiry today, so it's a good time then to track the futures and options queue. Mangalam is still with us. Mangalam, this time tell us about the F&O space.
Well, if you look at the indices, for 2 days in a row, it's the IT index which has been outperforming, whereas the Nifty Bank has been underperforming, and that continues today as well. So the Nifty Bank actually is low by about 1/3%, and that's caused a bigger downtick on the Nifty right now, which is down about 1/4%. The IT index higher by about 1/4%. So that's limiting the downside that we're seeing on the index. And the pain of that we're seeing in the broader markets as well, where the mid-cap index is actually underperforming a little more, with more stocks in the red than the number of stocks which are in the green. So those crisscross lines come up for you. They're far and wide apart, with the red one being a little above the green one itself. The important part, however, the Nifty over the last 2 or 3 trading sessions has been finding some supply near the 20-day moving average. So we'll watch out for, 25,658 as a mark to watch out on the way up as a resistance. But the Nifty Bank, what is actually a resistance for the Nifty will actually be a support for the Nifty Bank. So 57,665, which is the 20-day moving average for the Nifty Bank, would perhaps be a bit of a support at a time when the Nifty Bank is underperforming a tad. Weekly options expiry, typically straddles are written, which is, a call and a put, usually at different strikes or the same strike. And right now the range is fairly defined, 25,400 put, which corresponds to closer to today's lows. That has seen a fair amount of writing. So the street believes that this is a mark that the bulls will hold to defend. In fact, the 25,450 put as well would see some writing. But on the way up, the 25,500 call writers, they haven't yet given up on their positions or conviction out here. In fact, 4 crore shares written out there. So which means that around 25,530 thereabouts, there could be some bit of resistance. So if one had to, bet on a narrow range for expiry, it would be 25,450 to 25,550.
Thank you very much for that. By the way, October mutual fund data, the equity inflows have dropped from almost 30,000. It's come down to 25,000, sub 25,000. That's the number, 24,671, which compares with 30,400. So on a month-on-month basis, the net equity inflow has moderated. Mid-caps have seen a bit of a drop. So from 5,000 crore of inflow the prior month in September, it's come down to 3,800. We'll await this. Do we have the small cap and large cap number?
The large cap numbers are also down on a month-on-month basis. The large cap number was just flashing on your screens a few minutes ago. The total AUM, that has seen an increase on a month-on-month basis. But the net equity inflow has seen a decline. That the large cap fund inflow is now at 972 compared to 2319. So that's a big drop that you have seen. So the large cap fund inflow has more than halved compared to last month. The small cap fund inflow, it's a marginal drop, but still a drop of almost 1,000 crores from last month. And the mid cap funds too has seen a drop in inflows from 5,000 crores to just 3,800 crores.
There's one. Sorry, go ahead.
Go on.
There's just one point. The moderation that we've seen, this is the 3rd consecutive month of moderation. In the month of July, the total net equity inflows were 42,700 crore rupees. In August, it came down to 33,400. In September, further moderated to 30,400, and this time it's declined to 24,671, which means from a high of 42,600 in the month of July, the net equity inflows have moderated by nearly, that's the picture that we should put up. So this volatility that we've seen in the market has resulted in, some weakness in the equity inflows. And the IPO markets, not to forget that. Yeah.
Yes, and there's Anthony Heredia of Mahindra Manulife is joining in. Anthony, thank you for joining in. 3rd straight month of declines, but compared to prior months, this decline is appearing to be pretty substantial. Would you still be worried, or would you still look at it as a glass half full, saying that, you're still getting inflows of 25,000 crores every month despite the markets having gone nowhere?
So, hi. No, I would clearly take a glass half full view just for a couple of reasons. One, and I think Reema correctly pointed out that while net flows have dropped consecutively since July, you'll find that gross flows are pretty consistent around the 65,000 mark, which basically means that as markets have been volatile, as they've been range bound, there are people who are taking money off the table, booking profits, and so the redemption numbers are marginally higher. That's why the net flows drop. The second I would point out is there is the reallocation in a sense of investor interest from, I would say, just normal traditional equity to products within hybrid like multi-asset as well as gold ETFs, right? So if you get all of that in aggregate, the drop is not as stark. The final point I would make is, frankly, as we saw gold and silver prices, I would say, retrace some bit of normalcy in the second half of October, at least I've seen flows in the industry come back to pretty much July, August terms, at least in November. So given all of that, I wouldn't be worried. I think, 25, 30, 35, these are all sometimes function of current market situations. You also know there have been a number of IPOs, so liquidity gets sucked out to that as well. So I wouldn't see any cause for worry, but clearly I would point out that products like multi-asset, especially since they're the only products in our product portfolios that have a gold and silver exposure, clearly seeing much larger interest relative to what they were 3 and 6 months ago.
Got that. So money is chasing multi-asset funds, gold funds, etc. Anthony, generally money chases returns and returns have been muted. And now especially return expectations have been moderated a lot. Everyone's been saying that don't expect the kind of returns that you got in the COVID heydays. So do you think there could be this drop that we're seeing in the net equity inflows over the last couple of months is here to stay now?
I would say that these numbers or this range of numbers is here to stay for, I would believe, this quarter and the next quarter. For us to see a uptick from here, I don't think it's a function of people's return expectation, because I would just point out that, and that probably speaks to what you just said, the interest in multi-asset funds are also a reflection that they are the category of funds that still have close to double-digit returns over the last 1 year, relative to equity funds being close to negative or zero, right? So there is money influenced by recency of returns that's going to multi-asset. But I would say flows, to my mind, stabilize at around 25,000 odd crores to 30,000 crores. SIP flows remain stable, continue to grow. But for us to go back to the 45,000, I think we'll need some triggers which are market-related triggers for that to happen. And as you would know, those are impossible to predict in terms of when they will happen. But I would say the clarity around the tariffs front, probably the trade that's happening into emerging market equity, but India not being a beneficiary, starting to include India. Stuff like that, I think, will bring us back to the heydays of 45,000. Till that point, my personal view is we would expect to be at 25, 30, and the lower return expectation is not really a factor in it.
Let's also get in Sandeep Bagla of Trust Mutual Fund. Sandeep, thank you for joining in. Would you concur with Anthony of taking this glass half full view despite numbers declining for the third month in a row, and the fact that the IPO pipeline is not drying up anytime soon? You still have bigger IPOs coming in the next 6 to 7 months. So do you believe that this number continues to remain around that 25,000 crore mark, and we should consider this to be the normal at least for the next few months?
Hi, good morning. So see, I have a slightly different take on this. See, we have to divide the data of inflows into two parts, the SIP parts and the non-SIP parts. SIP is the true reflection of the retail participation, and that has been steadily increasing, which is the effort of mutual fund industry and distributors. And that is steady at 29,500 crores, and it is increasing, slight increase. The other is the part where the large HNI investors, keep moving money from whatever has performed in the recent past, and that money will keep moving from, NFOs, IPOs, gold, silver, whatever is working, real estate, that is something which is non-core to the mutual fund inflows. And I have been saying this repeatedly, that if you look at July, I think it was mentioned that there was 42,000 crores of inflows. That was because there were a lot of NFOs in that period, and a lot of this money comes in because the whole mutual fund machinery starts mobilizing money in a very concentrated effort. Last month, there were very few NFOs. There was one FlexiCap NFO of 1,700 crores, which is why the FlexiCap numbers have gone up. So I think whenever we are dissecting or analyzing about the mutual fund inflows, I think we should concentrate on the SIP flows, which are very, very steady. The rest of it is non-core, and it will keep moving around. And so I am not really worried about these numbers. The HNI numbers will keep fluctuating from time to time. That is the non-core part of our flows. So the core is very much steady. It's on the increase. So it's absolutely stable in my mind.
Gentlemen, thank you for sparing time and joining us today to decode the numbers from the mutual fund industry for the month. And we'll discuss more on this going forward during the course of the day as well. Take a short break, more on the markets on the other side. Welcome back. Ather Energy reported a mixed quarter. Revenues were up, but expenses were also on the higher side. The market share saw an increase as well. Tarun Mehta, the co-founder and CEO of the company, is joining us now to discuss the road ahead for the company. Tarun, good morning. Thank you for joining in. Losses also were narrower compared to last year because there was a significant increase in your other income. It was up 50% sequentially, almost tripled from last year. Could you talk to us more about what is this increase in other income? And do you see PAT profitability coming in FY27 or maybe even the second half of this year? Tarun, you're on mute.
Hi, so this was a fantastic quarter for us. Revenue was up almost 60-65% over volume compared to the previous quarter. Considerable growth on almost every parameter. Losses did come down. Our fixed expenses, there was a one-time hit in Q2 because of the rare earth crisis. We could not, we haven't applied for subsidy for the majority of our vehicles. If you account for that, the fixed costs barely grew by, I think about maybe 10 or 15 crores. And without that, EBITDA losses had come down considerably. Other income is nothing but treasury income, which on the account of IPO is a little better this quarter. But overall volume is up, gross margin is up, especially once you account for the one-time hit because of rare earth crisis. And EBITDA losses have shrunk because our fixed costs are largely flat quarter on quarter.
The rare earth impacted revenues by 19.2 crore, right? The restriction on rare earth?
Up to about 1920, yes. Correct.
And at the EBITDA level, what was the impact?
It'll be a little higher because to ensure that we ran production well, we had to obviously expedite some logistics. So there'll be a little bit more impact, maybe another 5-6 crores. So you can think of this as a net about 25 crores impact, but largely one time because the crisis is behind us in Q3 as we speak, and also looks largely protected.
Got that. So your EBITDA, X of this one-time impact, assuming the rare earth impacted EBITDA by say 25 crore for simplicity, you would be closer to 105 odd crore, 105, 110 crore at the EBITDA loss. What is that number likely to look like Q3, Q4?
So, if you look at our trajectory, our gross margin's been improving consistently. Even this quarter, we saw almost 100-150 pips improvement, despite actually Forex and dollar becoming more expensive. We expect this trend to continue because LFP continues to increase as share of business in our portfolio. And LFP batteries are relatively cheaper compared to NMC batteries. So this technology change led by engineering has been a considerable driver of margin improvement in recent quarters. Value engineering has been a very strong track record for us, and we expect it to continue paying dividends for another 2-3 quarters. And next year, we are expecting to enter our new platform, new low-cost scooter platform to enter our portfolio, which should further expand margins. So the overall margin trajectory is looking strong. On the revenue front, we've seen very strong success with our software attach rates. 89% of our consumers purchased additional software on top of the vehicle, delivering very strong margin support. And in our business model, we have not a very heavy fixed cost because we don't run our own dealerships. So that keeps our fixed costs relatively lighter compared to some of our peers.
So
the margin
EBITDA break even when, Tarun?
It's difficult for me to give that guidance. But I would say that at this point, operating leverage itself is doing the bulk of the work in taking us to EBITDA break even. While gross margin trend is very, very favorable and continues to get better, we believe operating leverage alone over the next few quarters should get us to a sustainable place.
And Tarun, your non-vehicle segment, 12% of top line, does that number increase or do you expect it to remain at these levels?
So the non-vehicle revenue for us is a few things. First is the sale of software, which, as I mentioned, has very strong attach rates for us and continues to be a strong margin driver. We are seeing early signs of this holding up well, even as we go more and more deeper in India. For example, in Madhya Pradesh, where recently we've grown our volume almost 3-4 times over the course of the last 1 year, we've seen our software attach rates opposite of what you would imagine. Our software attach rates have actually gone up. There used to be something like 50% attach rates that now hit 75%. So in newer markets, as we go deeper, we are not seeing software weakening at all for us. Particularly heartening has been our sale of accessories. Our accessory attach rate is also inching up every quarter. We've seen an almost, I think, 20-25% growth over the last few quarters at a pan-India level, with newer markets also holding up well. So as we go deeper, we are expecting this as a percentage of revenue to keep inching up. And finally, over a midterm, over let's say a couple of years, service revenues will keep compounding with a larger fleet size. It is still at a fairly young stage in terms of fleet size, with just about 5-6 lakh vehicles on road. As this value compounds, we expect service will also add considerable to our non-vehicle revenue. So overall, non-vehicle revenue should grow from 12% over the next year.
Thank you. Tarun, great chatting with you. Out of time, would have loved to get in a few more questions for another time. Well, with that, I think it's a wrap on this edition of Trading Hour. From the entire team, thank you for watching.